This is gonna blow your mind. It seemed impossible. The very foundation of the American dream was shaking, and no one could believe their eyes. The American housing market, a symbol of stability and prosperity, was collapsing. What was once a beacon of hope and financial security was now a crumbling edifice. Millions of families faced foreclosure. The homes they had worked so hard to buy were slipping through their fingers, leaving them with nothing but shattered dreams. Their dream homes turned into financial nightmares. The places where they had planned to build their futures were now sources of immense stress and uncertainty. Wall Street giants teetered on the brink of collapse. Institutions that were once considered too big to fail were now on the verge of bankruptcy, sending shockwaves through the global economy. The world watched in disbelief as the subprime mortgage crisis of 2008 unfolded, a catastrophe that exposed the fragility of the global financial system. The interconnectedness of global markets meant that no country was immune to the fallout. The crisis was a brutal wake-up call. It forced governments, financial institutions, and individuals to confront the harsh realities of a system that had been built on shaky ground. It revealed the dangers of reckless lending practices, unregulated financial markets, and a culture of greed that permeated Wall Street. The pursuit of profit had blinded many to the risks they were taking. From Main Street to the highest levels of finance, the consequences were devastating. The ripple effects of the crisis were felt in every corner of the world, affecting people from all walks of life. Millions lost their homes, their savings, and their jobs. The economic security that many had taken for granted was suddenly gone, leaving a trail of despair and uncertainty. The world plunged into the worst economic downturn since the Great Depression. Economies contracted, unemployment soared, and the future seemed bleak. This was not a natural disaster. It was a man-made catastrophe, a result of human actions and decisions that had far-reaching consequences. It was a man-made catastrophe, fueled by a toxic mix of arrogance and ignorance. The belief that the market could regulate itself had proven disastrously wrong. It all started with a seemingly simple idea: make home ownership accessible to everyone. This noble goal, however, was twisted and manipulated by those looking to make a quick profit. But this noble goal was twisted into a predatory lending machine, churning out mortgages to people who couldn't afford them. Lenders ignored the warning signs and continued to push risky loans. These risky loans, known as subprime mortgages, became the ticking time bomb at the heart of the crisis. They were designed to fail, and when they did, the impact was catastrophic. As the housing bubble inflated, fueled by cheap credit and lax lending standards, Wall Street saw an opportunity. They capitalized on the booming market, creating complex financial products that few understood. They bundled these subprime mortgages into complex financial instruments called mortgage-backed securities. These securities were sold to investors who were often unaware of the risks they were taking on. These securities were then sold to investors around the world, spreading the risk far and wide. The interconnectedness of the global financial system meant that the crisis was not contained to one country or region. What they didn't realize was that they were playing a game of financial hot potato with a bomb that was about to explode. The consequences of their actions would be felt for years to come, reshaping the global economy and leaving a lasting impact on millions of lives. The American dream. It's an ideal that has driven generations to strive for a better life, a life filled with promise and prosperity. It's a potent cocktail of ambition and aspiration, a vision of success that includes a stable job, a loving family, and a home to call one's own. At its core lies the desire for home ownership, a tangible stake in the land of opportunity. Owning a home is seen as a cornerstone of financial security and personal achievement. For decades, this dream fueled a thriving housing market. Neighborhoods flourished and real estate became a booming industry, with homes being bought and sold at a rapid pace. But in the years leading up to 2008, something went terribly wrong. The signs were there, but few paid attention. The market was overheating, and the foundations of this dream were beginning to crack. The dream morphed into a nightmare. What was once a symbol of success became a source of stress and financial ruin for many. The pursuit of home ownership became an obsession. People were willing to do whatever it took to own a piece of the American dream, even if it meant taking on more debt than they could handle. Fueled by low interest rates and the widespread belief that housing prices would rise forever, Americans rushed to buy homes. The frenzy was palpable, with buyers eager to get in on the action before prices climbed even higher. Demand soared, pushing prices higher and higher. Homes that were once affordable became out of reach for many, but the market showed no signs of slowing down. The market became a bubble, ripe for bursting. The rapid increase in home prices was unsustainable, and the bubble was destined to pop. Into this overheated market stepped the subprime mortgage. These loans were designed for borrowers who couldn't qualify for traditional mortgages due to poor credit history. These loans, offered to borrowers with poor credit history and low credit scores, were considered high risk. Yet they were marketed aggressively, promising the dream of home ownership to those who were previously shut out. But lenders, eager to cash in on the housing boom, threw caution to the wind. They relaxed their lending standards, approving loans with little regard for the borrower's ability to repay. They offered adjustable rate mortgages with low initial payments, often with little or no documentation required. These loans seemed like a great deal at first, but they came with hidden dangers. Borrowers, enticed by the prospect of owning a home, often failed to grasp the risks involved. They were drawn in by the allure of low monthly payments, not realizing that these rates could skyrocket. These subprime mortgages were ticking time bombs. The low initial payments were only temporary, and when the rates adjusted, many borrowers found themselves in deep trouble. When interest rates inevitably rose, many borrowers found themselves unable to make their monthly payments. The dream of home ownership quickly turned into a financial nightmare. Defaults and foreclosures skyrocketed, sending shockwaves through the financial system. Entire neighborhoods were affected, with homes left vacant and property values plummeting. The American dream, once a symbol of hope and prosperity, had become a trap for millions. The very thing that was supposed to provide security and stability had instead led to financial ruin and despair. Wall Street, never one to miss an opportunity, saw the subprime mortgage boom as a goldmine. The allure of high returns and the seemingly endless demand for housing created a perfect storm for financial innovation. They devised a way to profit from these risky loans by packaging them into complex financial instruments called mortgage-backed securities, or MBS. These securities were then marketed as safe investments, despite their underlying risks. These MBS were then sliced and diced into different tranches, each with varying levels of risk and return, and sold to investors around the world. The tranches were designed to appeal to a wide range of investors, from those seeking high returns to those looking for safer, more stable investments. On the surface, MBS seemed like a safe bet. After all, they were backed by tangible assets, homes. The housing market was booming, and it seemed like home prices would only continue to rise. Investors, blinded by the allure of high returns, poured trillions of dollars into these securities. They were convinced that the housing market was a one-way ticket to wealth and that the risk was minimal. They believed that the housing market would continue to boom, ensuring a steady stream of payments. The confidence in the market was so high that even the riskiest loans were being bundled and sold as prime investments. What they didn't realize was that these MBSs were built on a foundation of sand subprime mortgages. These loans were given to borrowers with poor credit histories, making them highly susceptible to default. As the housing bubble began to deflate and defaults on these risky loans soared, the value of MBSs plummeted. The once seemingly invincible market began to show cracks, and panic started to set in. The financial system, interconnected by these toxic assets, began to unravel. The ripple effects were felt across the globe as financial institutions that had invested heavily in MBSs faced massive losses. The collapse of the MBS market was the catalyst for the financial crisis. It triggered a chain reaction that led to the downfall of major financial institutions and a severe economic downturn. It exposed the dangers of financial engineering, where complex instruments masked underlying risks. The lack of transparency and understanding of these products contributed to the widespread panic and loss of confidence in the financial system. It also highlighted the systemic risk posed by interconnectedness, where the failure of one institution could trigger a domino effect throughout the entire system. The crisis underscored the need for better regulation and oversight to prevent such a catastrophe from happening again. Section 4. Cracks in the foundation. Early warning signs ignored. The subprime mortgage crisis didn't erupt overnight. It was a slow-motion train wreck with warning signs flashing for years before the crash. But Wall Street, blinded by greed and a culture of complacency, chose to ignore them. As early as 2004, cracks began to appear in the housing market. Home prices were soaring at an unsustainable pace. Subprime lending was rampant, with borrowers taking on more debt than they could afford. Analysts warned of a looming housing bubble, but their warnings went largely unheeded. The Federal Reserve, tasked with maintaining financial stability, kept interest rates low, further fueling the housing boom. Wall Street, incentivized by short-term profits, continued to churn out risky mortgages and complex securities. The regulatory environment, weakened by years of deregulation, failed to rein in the excesses of the financial industry. The seeds of the crisis were sown in a climate of complacency and denial. Wall Street believed that the good times would last forever. Regulators failed to grasp the magnitude of the risks building in the financial system. And ordinary Americans, caught up in the frenzy of the housing boom, were often unaware of the dangers they faced. Section 5. The day the music died. Lehman Brothers and the financial earthquake, September 15, 2008. The day Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy, sent shockwaves through the global financial system. This was not just another corporate failure, it was the day the music died, marking the beginning of the worst financial crisis since the Great Depression. Lehman's collapse exposed the fragility of the financial system and the interconnectedness of the global economy. The bank, heavily invested in mortgage-backed securities, had become a symbol of the excesses of Wall Street. Its failure triggered a domino effect, bringing the global financial system to its knees. Credit markets froze as fear and uncertainty gripped investors. Banks, fearing further losses, stopped lending to each other. Businesses struggled to obtain credit, forcing them to lay off workers and cut back on investment. The global economy spiraled downward. The collapse of Lehman Brothers was a wake-up call, a stark reminder that even the mightiest financial institutions were vulnerable. It exposed the dangers of unregulated financial markets, excessive risk-taking, and the interconnectedness of the global economy. Thank you for watching. If you found this video informative, please like, share, and subscribe to our channel. Don't forget to click the bell icon to stay updated with our latest content. Check out these other videos for more insights on the financial world.